Guys, good morning. Today we're going to work through the difference between value and growth and why some value investors fail to understand the potential of growth stories. We're going to go deeply, technically, in understanding why there is this mistake that some value investor make. So I want to start from an example. Look at this. Which company would you invest? Now, in the first company, you have a profitable company for the next 15 years. Sales and net income will grow close to 40% compound annual rate. Company will initiate a dividend in the third year, so it's amazing, and it will grow then eventually 50% compound annual rate. The second company is a company with negative cash flow for the next 15 years, as a level of debt which will grow 34%. Cash balance will start 2.5% sales, and it will dwindle to 2% by the end of the period. Which would you choose? Now, regardless if you are a value investor or not, probably any investor would pick the first one because that looks much more profitable. The funny thing is that if you really look into this company, you understand that this company is just the same company. It's the same company in two different periods of time. And we're talking about Walmart. So is the same company in a period which goes from 17 to 26. And if you take two segments, in the first instance, the company has been like the example 2, and of course in the second one is the example 1. That to prove that a company will become successful in deploying capital for the shareholder, so buying shares, distributing yield, distributing dividends, only after, of course, it was successfully implementing its strategy. By the first phase, obviously, the company will have a negative cash flow, and you will need to burn cash in order to build a technology which will give them a moat and a possibility to eventually grow. When you are a value investor, you're focusing in different things. But the shallow value investor, what I call shallow value investor, means the people that wanna make things easy. And I have a sentence for them, which you can see here. Value investing is simple. Unfortunately, so was that successful investing. And one of the reasons is because some value investors focus on low price to earnings. They focus on price to book. You need to be careful with those two things because those two things might actually drive you into what is called a value trap. There's a third thing that value investors focus on, learning from Buffett, of course, the free cash flow. What is the free cash flow? Free cash flow is the cash flow that comes from, the business once everything is paid. Warren Buffett had also a formula called owner earnings, which was the free cash flow minus the cost of that you need to spend for the company and the cost you need to spend for growth and for the sustainable earnings. When you have a low price to earnings, things sound attracting. Why? Because if you have a low price earning, means that earning of the company will be able to pay you back. You get the price back of the company in few years versus company which have a price earning very high, in which you need a lot of more time to pay you back the price of the company. Obviously, the yield looks much more attractive. If you have a price earning to 4, you will probably think that that company will be able to pay you back in 4 years. So 4 years means 25 years, 25% yield if you look at the earnings. And that makes sense. But if you look at price earning of 100, you would think, wow, take 100 years to pay me back, for the price I'm paying now. And you need to understand that the company is not a bond. A bond is a coupon, and the coupon can pay you a fixed amount. Even if the coupon is 0, you understand what is the yield to maturity of a bond because you have the price of the bond. Usually the price of the bond get paid back to 100. So if the price is lower than 100, you calculate how many years you need in order for the company to pay back. What is the expiration date of the bond? And you can calculate your return, what is called yield to maturity. However, in that time, the price of the bond will give you a feeling of the risk of the company. So if I have a company which its bond is priced, 60 or 70, you know that's a very risky bond, and the market is telling you, hey, be careful. I want to give you a bigger return because I think there is a chance that that company will not pay you back the bond. If you see bond which are priced at premium, so the price is even higher than the price they will pay you back, so the face value, okay, and they have a coupon or whatever. Anyway, you understand that the bond is obviously safer, and usually a bond. I mean, this is the investment grade bond, for example, are priced. They have very low return. Now the stocks are different. Stock is not a fixed. It's not a fixed price. It's not a fixed coupon. So the earnings would change. So the market cannot tell you what is how is the risk of the earnings. It can tell you only by reducing the price earning. When the price earning is low, the market is telling you, hey, I don't know if these earnings are sustainable. I don't know if those earnings can grow. Nonetheless, I don't even know if these earnings would be there in the future. So low price earning means the market is telling you we are afraid those earnings are not sustainable. Usually, low price earnings are for company which has been disrupted. What does it mean? Mature company which its business is not capable to be eventually sustainable in the future. Other company have to their market share with new technologies. Price to book is a very similar, well, it's a different concept, but it's a very similar problem because what price to book is? Well, price to book is whatever asset the company has, less the liabilities. So the equity is the book, right? What is equity? Equity is asset less liabilities. If you have a bank, for example, which is going to a price to book of, I don't know, 30 cents on the dollar, you think, wow, I can buy the value of $1 for 30 cents. And that sounds attractive. Usually older value investors, like some tens of years ago, were looking at low price to book. They were looking at low price earnings, thinking that the market, of course, assuming the market was wrong about leaving so much value in this company. But let's say a bank, as I said, going for a third of the book. Well, in that case, probably the market is assessing that the value of the loans those bank has been lending would not be repaid. So it would be impaired. They would be write off. What does it mean write off? Write off means that those value that eventually was there is not there anymore. So it's not been write off yet, but eventually will be written off in the next earnings or in the next quarter, whatever. Usually that happens again for technologies or companies that has been disrupted. There's not really a bargain in simply assessing a company that has a low price earning or a low booked value. A cheap company is a cheap for a reason. Look at the Gordon growth model. This company might look complicated for some of you. At the end of the day, it doesn't mean anything. I mean, you know that it's very easy. That's what I mean. What is an asset? An asset is only and simply the future sum of cash flow discounted by its hurdle rate, but minus the growth, because those cash flow will eventually grow, or maybe the growth will decrease. So if you look at this, and I see you, I'm pointing out that this is a distribution of a company. It could be the dividend, the increase of the dividend during time of a particular growth value, and then the other rate minus the growth. So if the growth is very high, then this model is kind of like cannot really be assessed, because the growth, you will have a denominator, a number bigger than the hurdle rate. This is to explain growth companies. Growth companies have a highest price earnings because they will price growth implied in that value. So what you need to do when you assess growth company is do a sensitivity analysis. We're going to show eventually how to do that, where you can understand what is the market pricing in, what growth the market is pricing. Companies that grew a lot have high price earning. They meant to grow those earnings exponentially. When those companies go to earnings, if they don't meet the growth which they price for, they get beaten badly at earnings. So if you see a beat up company earnings, a growth beat up company earnings, is because they either lowered dramatically the guidance or they did not meet expectations. Value investors know, and we acknowledge, there is risk in growth, and value investors are meant to be risk adverse. But if you want to be a real value investor, you don't look at cheap company. You look for something else. We have a specific way to assess company, which is the new way. Let's call it that way. The way that Charlie Munger used, the way that Columbia School used, or people that come from that kind of background use this kind of approach. They don't simply look if a company is cheap. Okay. Now this is a bit complicated, and probably it does deserve a special video. If you guys click a like and eventually tell me that you want me to explain that deeper, we'll do a video on that. But now I'm going to give you just a few indications. First of all, what we do when we assess the value of a company, we assess the asset value. The asset value is the company, is whatever is in the balance sheets. And we declassify this by paying attention to what should be the value of the book. The value which is written in the balance sheets is not always the same. Okay, under GAAP accounting, you have the price of a land, or the price of a particular factory or a particular asset, which is written for the price was paid for. The price might be not right, might be higher or might be lower for different reasons. Should have been impaired or might be much higher because it was an old value recorded, but meantime appreciated. Once we do that, we pass on to the profit and loss. On the profit and loss side, we look at concept of value investing, which is called earning power value. Earning power value is whatever earnings the company is able to produce in a sustainable way without considering growth. How you do that? Well, it's quite kind of easy, and there should be a system for that we can explain to you in details. But roughly, you take a level of the last 5-7 years of earnings. You make sure you discount the part which is spent for growth. You make sure you discount general expenses are not really meant for the sustainable earnings, but eventually meant for growth. You make sure you take the tax in considerations, and at the end of the day, you have a value that you capitalize at WACC. What capitalize at WACC means? The WACC is the weighted average cost of capital. And if you don't know that, we're gonna put a link on, to explain what is in details. But it's basically how much it costs the company, okay, between the cost of equity and the cost of debt, the average. What is the cost of the capital? Eventually, if you're able to produce a return which is higher than the WACC, that return can be capitalized. If you're not able to produce a return which is higher than the WACC, probably you're going to lose money, you're going to burn cash. After that, we assess what is the franchisee value. But we only assess the franchisee value if we understand the company as a moat. Hey, we are called moat investing for a reason. Moat is a high barrier to entry. If you don't have a high barrier to entry or a moat, okay, a particular reason why company cannot do the same and cheaper, a moat is not initial advantage of the first company moving into the space. That's not really a moat. On the long term, competition will catch up. If you're making big margins in a new field, that field with big margins is going to become pretty crowded because a lot of competitors will move into the space. And the only way to keep competitor away is to have a business which has built a moat or is building a moat. Okay, when you have a big TAM at the beginning, you can invest in growth company that eventually are building a moat. But you need to use a different approach. You cannot be value investing. So not all the approach in investing should be only connected to value investing. Value investing can be a safe approach if done properly. And you calculate what is the franchisee value, which is the value that that company should have just because it has that moat. Because that moat gives it an extra value which justify higher price. That's where the value investor make mistakes. If he does not understand, for example, this part, then of course you need to have a margin of safety, which is the concept of the value investing, to justify eventually a mistake on the valuation. However, a value investor would do what is called a comparison between the asset value and the earning power value relationship. You can come up with three different scenarios. The first scenario is that asset value is higher than earning power value. The second scenario is which is equal, and the third one is the asset value is lower than the earning power value. In the first scenario, we have a situation in which the company is not able to extract the right value from the asset. So it's a company which is management is not doing a job, or maybe the company is being disrupted. So you have an higher asset that you're able to extract from it. So the yield that you get from this asset is not necessarily is not enough to justify that those kind of assets. In the situation where it's a competitive market, it's a good management, you have usually the asset value equal to earning power value, and most of the time that's when you're trying to analyze value company. That's what you actually see. And the third situation is the earning power value is higher than the asset value. And this is a situation in which you have excellent management because the management is capable to extract a lot of value from those assets, more value than it should. And then you need to assess if that situation is sustainable. So if that company has a moat or not. Because if it does not have a moat, all the money invested in growth will eventually return to the value of WACC. So that will be destroyed. When you invest in a company which is spending money in growth, you need to understand if this growth could compound higher value than WACC. You can only do that if you have a moat, at least in the long term. If you're a momentum trader, you obviously probably don't care. But if you're a long-term investor, you need to understand that when the market realizes that the company does not have a moat and that money will be returning to the WACC value, so all this money spent in growth will be destroyed. Okay, the company will lose a lot of money in a day. You see company losing 30-40% in a day when another competitor could enter in the same space, which is the company's build the business. The market the same day realized that this company is basically screwed, and you will see the company losing 30-40% of the value, sometimes even more, and eventually not getting back to the same value. We saw that many times, many companies. What happened with the value investor? Why value company are not that great sometimes? Well, what happened is this, that those big managers, those big CEO, CFO, they study Wharton, they study at Harvard, and they have in mind to create shareholder value. It makes sense. Everything you do when it comes to listed company is creating shareholder value. So you need to manage those metrics that you have in a company in a way to create shareholder value. How do you create shareholder value? Well, you create shareholder value by lowering operating expenses, by buying back the shares, paying dividends, keeping costs low. If you keep costs low, you concentrate on your business, optimizing metrics. Those things are extremely attractive for a value investor. Value investor really look for management which are able to extract shareholder value. Activists, for example, come and try to organize company in a way to extract shareholder value. And that's great. But there is one problem, that when you do that, you cannot afford to spend money for the future. You cannot afford to improve your company, to create technologies that are great for the company. You cannot afford to go into niche market, which are not necessarily market profitable at the moment, okay? And you need to just concentrate on your market. And this will create a problem because one day the disruptor will come around and he will steal your market. From the niche market, this niche market will become a big market, and eventually the new technology will disrupt your company. Let me just show you DCF value trap. What is DCF value trap? Is the discount cash flow trap. So the cost of doing nothing. You analyst or you CEO need to understand that when you do not reinvest in the company, when you do not spend money in research and development, because you need to optimize shareholder value, that cost of doing nothing has actually a cost. It's not free. The company will eventually get disrupted. Now, this is interesting. Let's go in details here. All right. Let's understand from an analyst point of view what are the consequences of this. When you are an analyst, there is three metrics. People only think about two. There is three metrics which are extremely important, which if you change those metrics, the value of the share is very different. For example, if If you do discount cash flow analysis, you concentrate on growth and you concentrate on the hurdle rate. So moving the hurdle rate and moving the growth will give you extremely different result on the valuation of the company. Usually, it's pretty easy, at least for a few years, to understand using the consensus what could be the estimated growth. The hurdle rate, I mean, more or less, value investor or even growth investor, they will base their value on either on the interest rates and what is at the moment the cost of treasury plus the premium for the risk. But eventually, everybody, all of us, go around 10 to 15% depending on the expectations of return and on the risk. What people don't understand, the difference is in a third metric. What is this third metric? Is the terminal value. The terminal value is responsible even up to 100%, 70, 80, 100% of the value of the final price. And the terminal value depends from wherever the company will grow or will be disrupted in the future. If the company has invested in intangible, then the company will be able to keep growing at a higher rate. If the company has not invested in intangible, does not have any technology, in 10 years that company will not grow. The terminal growth will be minimum zero or even less, even decreasing. And that changed dramatically the price of the share. If you do calculation and put 4% terminal growth or 1% or 0.25% growth, you see the price change dramatically because that's a perpetual value that you are actually input in the formula. So that where things change. So this is one of the issue that some analysts fail to understand. They look how attractive is such a low price earning without understanding the reason why. Or they see how unattractive is such high price earnings, such a high estimated growth, without understanding if the company is spending money. GAAP Accounting does not have any ability to capture the research and development that the company is spending in a technology. Research and development through GAAP Accounting go through the profit and loss. They go through losses. So you have losses that you cannot, capitalize in the GAAP Accounting. But the truth is that all those losses that you see year by year spent in research and development, if they spent properly, they are spent to create technology that will create a stream of future cash flow, which would be essential, be extremely important for the future of the company, and which will make a big difference. So this is one of the reasons why people fail to understand. Look at this. Look at the performance between innovation, growth, and value. Look at this. How much ARK Invest has outperformed Berkshire. Berkshire is being completely destroyed by ARK. And we can argue that, the amount of money available to Berkshire is much bigger, it's much more difficult, Warren Buffett has been a star. But the truth is that Warren Buffett has failed to understand the innovation process. Okay, what is the innovation process? Well, the innovation process is how innovation works. On the left side, progress of technology performance, and on the X, you see the cost and time. And those curve that you see here, it's called S curve, is just that, to make it easy, means that at the beginning, the progress of technology is very slow. So you do not see with time and with cost a lot at the beginning. You don't see a lot of value in it. You don't see a lot of progress in it, because that when technology is still at early stage, it takes time for technology to pick up. It takes time for the technology to be successful and to develop in something which is quick, which is nice, which is useful. Only eventually afterwards, when technology speed up, then you see a curve which will show you that the progress improved dramatically the performance of the tool, of the technology. The technology is able to scale and produce meaningful value to the people, and to the sector. You need to try to invest at early stage and wait years in order to compound the value, or try to understand how to invest before there is that S point moving. Why? Well, what happens is at the end, when the curve is moving, Another technology was moving higher, it reached a level like a plateau, right? At that point, there's another technology coming in, and that technology could replace and disrupt the existing one. So that's the way it works. There's another issue that need to be actually taken in consideration. You cannot create great company, a great mood, without having free cash flow burning at the beginning. All the greatest company in the world, as I proved to you, as I showed you at the beginning, in order to become whatever they are and to create a mode, they have to spend money. They have to create valuable technology, valuable mode, valuable business model. It takes time and a lot of money to develop in order to have that barrier, and to develop technology which is totally disruptive. So be careful when you invest in a value company. Only invest in value company if you understand, that those companies are valuable, not because simply they're cheap, but because you did assess their mood, you did assess their franchising value, and you have a good margin of safety versus their franchising value. Cheap means nothing. Most likely, cheap means a value trap. Also, if you think that a company is a bad investment because it's burning money, well, think twice. Think what they're burning those money to. Is those money burned in stupid things, or is burning in research and development, which is not burning, or they are creating something? Okay, look how much is the value of this research and development. Go into the balance sheets. Sum those research and developments up. Capitalize this research and development to a WACC or to a value that you think is feasible, and try to understand, what could be the value of those research developments spent during the last 10 or 15 years. That makes a big difference. And you can do that with Apple, with Facebook. You can understand that. Or look if a company is, when the company is only distributing dividends or is only buying back, think why it's doing that. It's because it does not know where to invest anymore, does not have any new idea, does not developing a new technologies. Remember the terminal value trick. Remember to value a company by adjusting the terminal value according to how much money they spend or they're spending in technology. If a company is only squeezing money to give that to the shareholder, remember that has a price, and that price needs to be included in your valuation when you look at the terminal value. Guys, if you like this video, please click a like, and hey, thank you for listening.